I think there's something to be said for capital efficiency. And that seems to be a term that frankly went out the window with the last cycle.
Coming up, we're talking to Michael Lavin, who's the managing partner of Germinate Ventures, all about investing in AgTech right now. The Modern Acre podcast explores the latest in business, investing, technology, and sustainability in agriculture, and we're your hosts, Tyler and Tim Nuss. If you'd like to dig deeper with the Modern Acre, be sure to check out our membership community, the Modern Acre Co-op. The Modern Acre podcast is presented by Pinion. The economics of farming are increasingly difficult, and many producers are asking Pinion, the leading food and ag business advisory firm, questions around thin margins and cash flow. Farmers want to know how to calculate the total cost of running the business and determine their farm's true break-even. The answer is twofold. First, calculating beyond the field is critical. Second, ensure you know your true costs. If you're struggling with this, Pinion advisors can perform financial calculations that identify places to cut expenses and ways to optimize your farm business. Learn more at pinionglobal.com or hit the link in our show notes. All right, Tim, I just got to get something off my chest. I have a story to tell you of something that I think, is a story about life, but it's a story about business. My family and I, we're going on walks around the neighborhood pretty frequently, right? Like it's typically once a day, either I'm going on a run or I'm taking the girls on a walk. We're going to the park, riding bikes, right? Getting out and exploring the neighborhood. So as one does, we always take note of the different houses in the neighborhood, what they're doing with landscaping, if there's any remodeling going on, just being nosy neighbors, right? And there's this one house on the way to the park that the landscaping is just terrible. There's weeds everywhere. There's just an abundance of materials. It's rocks and overgrown plants. It's just crazy. And you think a house like that is just like the owner just doesn't do anything with it. It just kind of lets it sit by. You have some of those houses in the neighborhood where they just kind of let it go wild. No landscaping, no gardening. No. In this instance, there's constant activity. There's constant activity of bringing material in like bark or rocks. And there's always something going on there. They're sweeping outside. But in the end, it all still looks terrible. There's still weeds everywhere. And I, as a OCD person, I can't handle it. I can't handle that you're putting all this work in to this yard, but it's not seemingly getting any better for months. And I think that this is an analogy, Tim, of business. I think there's a lot of businesses where you're focused on the wrong stuff. You're focused on activity, but not actually output or effectiveness. And I just want this person, let's just start with the weeds, okay? Let's get rid of all the weeds in the whole yard before we start adding crap to the yard, okay? Let's just get rid of the weeds. But yet, every time I pass, they're working on some new project. It seems like they are really working hard, but not on the right things. So my comment here, Tim, my takeaway is, are you working on the right things in your business, the things that are actually going to drive effective outcomes for your business? End rant.
I didn't know where you were going with the story, Ty, but I like it. Not chasing shiny objects as one tends to do, where there's all these awesome things you could be doing as a business, but sometimes really honing in and focusing and finishing a project before you start a new one is good advice.
Just hold on the river bottom rocks, okay? We don't need the river bottom rocks. Let's just take care of the weeds. Let's just get out some of this material so you can focus on the positive outcome.
I thought you were going to throw in that you just got so fed up that you chipped in over the weekend and just started helping them clean up the weeds.
Absolutely not. No, this is a lesson they need to learn themselves. All right, but this is a perfect segue into AgTech, all right? Because there is a ton of activity in AgTech. There's been all these changes in valuations. We get into all that with Michael on this podcast. And I think it's important to view it through the lens of AgTech providing actual solutions that make an impact on farm, right? I think is really important and is sometimes missed. So Tim, this was a really fun conversation with Michael, managing partner at Germinate. They've been investing in the space. I think they have a really kind of differentiated approach to venture capital that's, I think, distinct from others in the space. So he gets into their approach, what he's seen in the industry. Tim, one question he answers is, what are like red flags right in at the beginning of a pitch meeting? Do you kind of know or not know if that investment is worthwhile? So there was a ton of gold in here. We'll jump in with what's top of mind for Michael right now.
Well, we've got a lot of investments taking place right now. It seems like a really exciting window of opportunity in the sector, and we've been very busy in diligence on a number of opportunities. And some of them are crossover from last year that are converting this year into closed investments, and then a lot of new opportunity as well. So we're just trying to make sure that we're spending the most amount of time possible on the right opportunities, doing the quality diligence that we're known for, and driving the winning outcomes.
Maybe let's dig into the diligence process a little bit. Like, how do you come about like the prospecting the deals, and what's the timeline typically look when you're introduced to a business from start to finish for when you actually finance the business?
Sure. Yeah, I really appreciate that question. I think it's something that is on our mind pretty much 100% of the time because it drives everything that we do. So I mentioned that we've got a lot of opportunities right now that we're looking at. Compared to a lot of other venture funds, it actually might not be so many in terms of what we're doing real quality deep diligence on. Our cadence for investment tends to be 1 to 3 new company investments per year. And that's pretty different from the norm. Others might take shotgun shots, but we take rifle shots. And I think that pretty much drives everything that we're doing. And the reason for that is because we really like being concentrated in great opportunities. And we also really enjoy and find value in being extensions of the teams that we back. And we find that just doesn't scale with an approach that is more of that shotgun nature. Granted, the empirical evidence does show that in venture capital, that does drive outcomes and it does work well. So that's just our approach. It's what we like doing. And so when we look to invest in companies, when we first are scouting for companies and new opportunities, and then doing diligence and then adding value in the company building process, we're really focused in terms of building a system in our portfolio. And we're very thesis driven in that sense. So we're going out to the market, we're canvassing the landscape for opportunities that fit our specific theses. And then either we find an opportunity or not. But in any case, and in all cases, we refine our theses quite meaningfully through that process. And in terms of the due diligence, I come from an M&A investment banking background. And so my approach is, and the team that I've built, our approach is to apply best practices M&A due diligence to venture investing. And what I mean by that is we're really thinking about post-merger integration upfront in a sense. So going back to that system, company building philosophy around our portfolio, we're thinking about our 100-day plan throughout the diligence process. We're thinking about what are the risk factors here? How are we going to help mitigate some of these risks? What are the levers for growth? And how are we going to bring unfair advantages to the companies and the founding teams?
Really interesting because, you clearly intentionally went a bit of a different direction from traditional VC of that shotgun approach. How do you think about, that is a proven model. It has proven to have success where you're really finding the one company in the firm that returns the fund. Do you have to kind of model things differently with this approach of your maybe having a higher hit rate, but not the 1 in 100 that returns the fund? How do you think about the economics?
Yeah, I think that our economics may be different than some others, but in a sense, it's probably fairly similar. I think that the way those other firms tend to work is they may write a small check, and then companies, as they perform and prove themselves and drive greater conviction on part of the investor, they then follow on with a much more significant check. They graduate to that level of receiving that next check. And in a similar sense, we keep about 2/3 of our capital, of our committed capital, at least that is, in reserve for follow-on rounds. In addition to that, our investor base also has an appetite for special purpose vehicles, which we'll spin up every now and then on a bespoke basis, and that can add a lot more. But we end up following a similar fact pattern in terms of check writing, I suppose. We may be keeping more of our capital in reserve for follow-on rounds, but it follows a similar pattern. We're very focused to make sure that we're not overextending ourselves with initial checks and that we will have that opportunity. So hopefully we end up having something similar, but we have to be better at winner selection, I think.
Michael, speaking of follow-up rounds, does the approach to diligence differ when you're going from a Series A to a Series B? Like, how are you looking at kind of those milestones? And from an investor point of view, do you like to see the follow-on rounds, or do you like to see the company raise once or twice and then be in a position to exit at that point? Like, what's better from your perspective?
Gosh, I mean, if you can raise less capital but achieve the same outcomes, that's ideal. There was a founder that in our portfolio, and we love him, God bless him, but after one of the rounds he called me up, and we shared a congratulatory moment together where he was saying, "Hey, we've almost raised $100 million. That's pretty cool, right?" And I said, "Yeah, that's pretty cool. It would have been cooler if you had raised half that amount and gotten to where you are." So I think there's something to be said for capital efficiency. And that seems to be a term that, frankly, went out the window with the last cycle. When we started Germinate back in 2017, that was something that we started looking for in all of our opportunities. And I think it was commonplace that investors were diligencing for that aspect. But then in 2020, 2021, and later, it seems to have been forgotten, but it's coming back now.
All right, Michael. Well, we have much to discuss, but let's take a step back, learn a little bit more about you. Tell us a little bit more about yourself and what ultimately led you to start Germinate.
I mainly come from an investment banking and corporate finance background, but I have deep roots in agribusiness. So I didn't grow up on the family farm like you both did, and I think that's a special thing that you should cherish and treasure, and I'm glad to hear that you're both involved still in the family farm. In my case, my family has a company on the protein side and manufactures mainly animal proteins, but also some vegetable protein products for a number of food service customers. And I worked there throughout college, basically from on-farm through further processing into corporate, where I did a lot of risk management and treasury activities. But then once I graduated, got my master's degree in finance and joined a diversified financial services firm here in Chicago called Mesirow Financial, which has been a tremendous experience in my career and has really shaped me and put me on a completely different trajectory than I anticipated. And there, first I started working in the consulting group, which had been purchased from KPMG and specialized in corporate turnarounds and restructurings. So I saw a lot of clientele and business models that frankly weren't working. So I saw the worst side of things and actually ended up doing a lot of forensic investigative work on a number of high profile fraudulent conveyance cases. And then after some time in that group, I went over to the investment banking group, and it was actually once I was asked to do that by the CFO and another person, and it was on loan. I was supposed to be on loan for 3 months, and I never went back. So I stayed in investment banking for 5 years, and there I mainly represented founder and family-owned companies. So closely held clientele, mainly the sell side. So selling their companies to top strategics, being in the Fortune 500 and tier one private equity firms. And that was a tremendous experience. It was great representing founders. I love working with founders. I always saw my job as being a 4-digit extension away from the client. And that's how we approach working with founders and our investors. And frankly, our industry peers and colleagues today is we should make the experience feel like we're 4 digits away and that we're in service to them. And I think that's worked really well for us. And I was very fortunate to be brought under the wing of a person I worked for who's now the head of the investment banking group, who brought me up to the upper echelons of the firm to help him work on corporate development activities. So it was 3 of us that ultimately led all of the M&A strategy for the firm. And that gave me exposure to the board and executives. And that's where I learned financial services, fund management, and saw a number of interesting models in alternative asset classes.
That's awesome. Michael, you've been doing this for a long time. I'm sure you get pitched a lot. Would love to get your perspective on kind of when you're getting pitched by a new company, like what are some red flags or what are some things that really stand out to like move to the next level of diligence to further the conversations?
Man, well, first, I'd like to take the opportunity to say, I feel like with the pitches that are best, you kind of know it in the first minute or couple minutes. And I don't mean to say that to put undue pressure on people, but specifically what appeals to me in those moments are when somebody starts pitching and telling you, this is where everyone else is focused, but this is where I'm focusing. And they're missing everyone else is missing this opportunity. It's almost like they're bringing you into a secret. And it's like they're underfunded, they're ignored. Everyone takes this other thing for granted, but that's the challenge we're going to tackle. And you start to see that there's a very clear, unique wedge that they are driving at. And that is really compelling, I think, especially when it aligns with a major market opportunity. So that's something that I guess on a positive note, we love to see. In terms of red flags, I'd say it's the lack of that and kind of recycling everything that we're reading about, just hype cycle, headlines and buzzwords. And then also when they seem cagey, I think, when they're reluctant to answer questions, when the conversation is too guarded, I think that's a red flag. And also when they have lack of a commercial vision, I'd say is also a significant red flag. There's a lot of really cool tech, but we don't invest in technology for technology's sake. We often like to say internally that we don't invest in technology that is essentially trying to kill a flea with a steamroller when a hammer will do. So that's a key red flag. And then the last one I'll mention is when you start to see in the pitch and in the company's plans that really multiple miracles have to happen in order for it to succeed. So at Germinate, what we like to say on our team and in our discussions comes up very regularly, almost every week in a meeting when we're going through our pipeline, is this a multiple miracle company or a single miracle company? Because we really only invest in single miracle companies.
I love that. That's a great framework. I think there's a number of multi-miracle companies out there for sure. But no, that's super helpful. I want to just dig in on kind of where we're at right now in AgTech. You mentioned, you started this in 2017. We saw the years of 21, 22 with really crazy valuations. Now we're seeing that return to normalcy. Like, what's your perspective on from like a valuation perspective, M&A activity, investment activity? Like, where's your head at with like the current state of investing in the space?
Well, when we started in 2017, one thing that really drew us into this opportunity was just recognizing how much of a contributor agriculture and agribusiness is to global GDP and to the world. And not just the normal, you've got to feed people by 2050, and that means you have to increase food production by 70%. That's the number. Those are numbers that are often circulated. But frankly, food and agriculture is the largest employer and it's extremely important to the health and wellness of our nation and our economics and so much more. And it contributes about, at least at that time, it still does, about 20 to 25% of GDP. And at that time in 2017, I believe it was only attracting about 3.5% of total venture funding. And in the peak years of the last cycle, that number climbed significantly, almost to 10%, I believe. And so while 2023, while we've seen a significant correction take place over that year and about 50% funding decline in the sector, we think that we've returned to some healthier vital signs in agri-food tech. While the amount of funding that declined was dramatic, it wasn't as dramatic as the number of deals that were being done. And so we saw that round sizes were essentially shrinking. The amount of deals being done were less dramatically decreased. It was about a 26% decline. But this basically signals valuation corrections across the board. And for an investor, I think that that's a really exciting opportunity. So if you have dry powder, there was no reason you should be on the sidelines. I think it's an opportunity to buy. And we're one of those investors, certainly. I also think that in the last cycle, there was a lot of hype around doing deals quickly, sacrificing your quality due diligence, competing for opportunities on the basis of extremely founder-friendly terms. And ultimately, I don't think that really benefits the founders. I don't think it benefits the investors on the cap table. I think that we need to be realistic about what the valuations are of these companies. And I recall my earlier career in investment banking and the number of years, the amount of effort it took to build high quality companies that are worth what some of these companies are fetching. And you look at the businesses of these companies and they really don't have the fundamentals. They do not compare at all. And so, granted, you're selling the future in a lot of that, but we have to all be realistic. And so I'm excited by the buying opportunity right now. I think that we've returned to normal levels. It's been good to see that agri-food tech has attracted more venture funding dollars, and it continues to. It still continues to be way ahead of where we were when we set out in 2017.
Michael, what's getting you most excited right now? There's a lot of different segments within AgTech investing. Like, what areas are you really focused on or find most interesting?
As I mentioned earlier, we're very thesis driven, and we spend a lot of time on it. I'm really excited by a lot of the technology trends that are happening outside of the sector that are acting on it. I think that there's a real convergence of the real and digital, which is basically the farm and the supply chain. And everything we're seeing happening in artificial intelligence and new optics technologies and others are accelerating the pace of innovation. This is exactly the type of period and dynamics you look for when you're trying to define Moore's law. And so we're really excited by the current period of time. And as we think about all those different technology advances that are taking place and how they converge on food and ag, we've established 8 key areas that we're focused on. And I'll mention just a couple of them. One is called, one we refer to as transforming point of care to the plate. So a lot of other folks might call this food as medicine, essentially. That's what that is. We're looking for within that, how do we harness the microbiome as a druggable organ that can also be modulated with nutrition? And we've canvassed the landscape looking for a company. We found a company. We made an investment recently. That's one opportunity that fits within that key area. And others that we're looking at there are fintech interventions, for example. So FSAs, for example, that could work for qualified food purchases, making healthier food more accessible, tax efficient, essentially, and affordable, but incenting people to purchase higher quality foods that are healthier for them and making more biodiverse diets. That's another that's within that same key area. And we have 8 of these key areas, and they all roll up to our 3 core verticals that we invest in. One is upstream ag tech, the other is food tech, and the third is frontier science and computation. And the third one is a little bit, probably worth explaining a little bit. It's not necessarily separate from food and agriculture. It's just that we should be allowed to follow the best science and technology innovations regardless of where they originate. Oftentimes there's great technologies that originates within the sector, but many times it originates outside of the sector. For example, in AI or computation or biology and life sciences. And we want to be able to invest in those opportunities, still tied in with a food and ag thesis, still tied in with our other key 8 areas or one of them, and invest in that knowing that eventually it can have a very transformational impact to the food and ag system.
What's an example of that? Is that like, I think about, I'm blanking on the name, but the production board invested in like that, like countertop drink technology where it basically develops every drink you can imagine from basically the ground up at the molecular level. Is that kind of the idea? Basically something that's not directly food industry or ag industry, but more rooted in kind of the biosciences?
Yeah, I mean, first, I would love that machine on my counter. I would be having a Lafitte Rothschild right now, but I'll explain an example. So last year we led a round in a company called Matterworks, which is based in Boston. And Matterworks recognized that biology doesn't have a semantic foundation, and the data for biological data is extremely unstructured. And so as an AI company, what they set out to do is create the semantic foundation for raw biological data or spectra. And there's well-known common lab instruments that basically produce this spectra. You put an organic sample into a liquid chromatography instrument and then a mass spectrometer, and out comes this raw data, right? Well, they created the semantic foundation for it, in doing so essentially a large language model, but for the language of biology. And with this, they're using it as a foundational model on top of which they'll develop and are developing fine-tuned models for various applications throughout industrial chemistry, life sciences, and pharmaceutical discovery, diagnostics, and potentially crop protection chemistry is another one. And also food and nutrition are also use cases. So what they've done initially with their first product, which they've launched, so each of these fine-tuned models will go to market as a product that the company sells. Some of them will be through partnership with some of their partners, which span these same sectors. But the first one is called Pyxis, which is used by mass spec users. So mass spec users put a sample into their instruments. They get this data readout. They're only able to read less than 1% of that data. And the rest of it is really unknown to what's there in absolute quantities on a molecular basis. The holy grail is being able to see 100% of what's there on a fully quantitated basis. I know this is very abstract, but bear with me here. So they're able to reveal all of this information with extremely high accuracy in a matter of minutes. And it really changes the paradigm of drug discovery and discovering new mechanisms of action and new things, essentially, that you can bring to market. I'll give you an example of an agrochemical company. One of the majors does 1 million samples of this per year. And their workflow basically to interpret this is about $120 to $145 per sample. And Matterworks is charging a fraction of that. And if you quantify the cost savings and slap on the EBITDA multiple of that one customer, you can see how this is worth about $350 to $450 million to just that one customer.
Yeah, super cool hearing about these companies and stuff like what David Friedberg is doing with Ohala Genetics, of using AI to basically take a process that's taken a very long time, that's been very capital intensive, as a way to do that on a much quicker time horizon, and in crop breeding, what you're doing on the input side and product side. I think it's really cool to see some of these companies actually get to commercialization. You've been in the space for a long time. What's your ag hot take?
I think exits are elusive. I don't think people disagree with that, but I think that there's a lot of optimism in the sector, which is great and it's much needed. And there will be exits. There are exits. There will be exits. But I think that that folks should be really mindful that these exits are elusive. It's really hard to predict what companies are going to become the most valuable to what acquirers. And I really think M&A is probably one of the most logical paths to exit. With regards to IPOs, I know it's a big aspiration of a lot of founders and a lot of investors to take a company to an IPO, but a lot of the IPOs that had happened in the last cycle hadn't really been able to maintain their valuations, number one. And number two, about 10 years ago, there were about 80 venture-backed technology unicorns. And today, there's more than 1,000 of them. And so we've seen that number skyrocket. At 2021's accelerated rate of IPOs, it would require 10 years to work through that backlog and actually IPO all those companies. So there's a significant number of these unicorns that are backlogged. And by the way, we also decided to do an analysis, and we counted the number of technology multi-billion-dollar or billion-dollar plus technology companies on the public markets. And I'll tell you that the privately backed unicorn figure also dwarfs the number of publicly traded billion-dollar plus market cap companies, which is scary to think about. So I guess I would issue a word of caution. My hot take is issue a word of caution to founders and investors that IPO isn't what we should all be banking on. Certainly, those will be opportunities for some of the companies that we're investing in and building, but we shouldn't consider that as the primary exit path.
Yeah, there was also a frenzy 18 months ago with going IPO via SPAC, and that was not necessarily the best outcome for everyone as well.
No, absolutely not. Yeah, and I'd really like to see private equity also participate more actively in acquiring these companies. But in order to do so, I think these companies have to achieve a certain scale and predictable levels of cash flow that can entice them. So I think I'm not saying that we should be forcing them to become profitable ahead of scaling to a meaningful quantum, but at some point, if you start to slow down, it does justify shifting gears towards profitability, and you can build a really solid quality business that then achieves a great outcome for you and your investors.
I think you're spot on, and I think that's where the industry really will go. I think that's where it needs to go, is the venture-backed startups having more realistic, sobering valuations, and in turn, with that focus on profitability at scale, like you mentioned, that can warrant a positive return when private equity comes into play. I think kind of the venture capital getting a little closer to the middle and private equity going a little closer to the middle, I think that is really necessary for the evolution and maturity of the ad tech ecosystem. And I think that's what is going to happen. Well, Michael, this has been a ton of fun. We really appreciate learning about how you're thinking about investing in the space. As we wrap up, how can listeners get in touch and connect with you and Germinate?
Well, I would love that. Contact me on LinkedIn. I often look there and I'm able to message you back and shoot you my email address. So please do reach out.
So, Tim, what'd you think?
Super fun conversation with Michael. It's always fun to chat ag tech and venture capital, and we're in an interesting time right now. So it's just fun just to talk about the realities and kind of level setting that's happening right now, and kind of a return to first principles, something we've talked about on the podcast the past 6 to 12 months. So it's cool just to hear about his unique approach, how he's still re-energized on the space, and how he believes that venture capital is the right funding solution for a lot of businesses in an interesting market right now.
I think it's a big opportunity, right? Like in a down market, that's where really the opportunity lies to make a good investment in the space and to see who's differentiated that can have a really, really solid outcome. Hope you guys enjoyed that conversation with Michael. Share it with a friend. If you enjoyed this conversation, we really appreciate you sharing the podcast with a friend or a colleague who is in ag tech that might find it interesting. And as always, make sure you subscribe to the podcast. We really appreciate the support and following the show. We'll talk to you next week.